Here's our video on how owners of limited companies can pay themselves tax efficiently. Tax rules are complex, so we do recommend you consult a qualified accountant for further advice. The owner of a limited company has some important decisions to make about how they pay themselves in the most tax efficient manner. Typically, a company director will pay themselves a small salary and take further profits from the business as a dividend. Salary is a deductible expense for corporation tax, and at low levels it can be paid without incurring any income taxes or national insurance contributions. You can pay yourself a salary of up to £8,632 in tax year 2019-2020 before any national insurance contribution becomes payable. Above this amount, both employee and employer NIC is due, usually at a 12% and 13.8% rate respectively. In paying a salary, you should make sure you pay enough that it counts towards your eligibility for a state pension. Currently this number is £6,136, the lower earnings limit for NIC. In paying a salary, you also will make use of your tax-free personal allowance. You currently pay no income taxes on income up to your personal allowance of £12,500. Remember that other income along with your salary will count towards your personal allowance threshold. For income above your personal allowance, income tax is payable at 20% up to annual income of £50,000, 40% between £50,000 and £150,000, and 45% thereafter. You can also consider paying family members a reasonable salary for the work they perform for the business to make use of any spare personal allowances they might have. Dividends are paid from business profits after corporation tax have been deducted. Dividends are not a deductible business expense for corporation tax, but there are no national insurance contributions to pay on them, either by the employer or the employee. Additionally, as an individual, the income taxes due on dividend income are at lower rates than apply to salary income. You can currently receive dividend income of up to £2,000 without paying any income taxes. For dividend income over £2,000, you currently pay 7.5% if your annual income is up to £50,000, 32.5% between £50,000 and £150,000, and 38.1% thereafter. In addition to getting the right balance between salary and dividend, make sure you are taking advantage of tax-saving opportunities related to company pension schemes. The cost of a pension will be an expense deduction for corporation tax, and you will pay no income taxes or national insurance contributions subject to annual allowance and lifetime allowance thresholds. Tax rules are complex, so we do recommend you consult a qualified accountant for further advice. At Currells, we will be happy to help. Give us a call or drop us an email.